How are you doing? This is David W. Williams, also known as Diamond Dave. And what we're going to talk about is the fastest way to six figures as a trader in 2023. If you're a trader, you're looking to try to figure out how to have some trading success. You've dealt with a lot of downturns. You've had a lot of obstacles in the market that not allow you to get the success that you desire. I think this could be a really good video for you because one of the things about YouTube is you get a lot of entertainment, but you don't get a lot of really solid training education. And you don't get a lot of really solid trading I would say commentary, but you do get a lot of really, really powerful entertainment around the trading space. And if you want to kind of get out of the entertainment space and get into more to kind of understand how to get successful as a trader, I may have some information that can be beneficial to you. It's not going to be investment advice. It's just going to be my own opinion. But really quickly, because we're talking about trading, we're talking about the options market, we're talking about the derivatives market, I have a really special offer to you from the sponsor of our show. And so the sponsor of our show is going to be No Better Do Better Consulting. And so what I want to ask you is that, are you interested in learning how to trade options one-on-one? You want to reach out to Dr. Chastity at No Better Do Better Consulting or KBDB Consulting, and you will learn step-by-step what platform to trade on, how to trade, and most importantly, how to consistently pull money out of the markets. And that's going to be in a one-on-one format. And so what you can do is you can book your free consultation at the link provided. It's also pinned in the chat. And what you're going to receive is 20% off. Your session will be only $60 an hour instead of the normal $75 an hour. And I want to encourage you to mention the channel when booking so we can know where you're redeeming the offer from. And I want to really encourage you to look into this particular offer. It could be time sensitive. If you sit on your hands and wait, it may not be available to you 90 days down the road. Okay, so that's the sponsor of the show, No Better Do Better Consulting. And so let's talk about the fastest way to six figures as a trader in 2023. And the reason why we want to talk about this is because many people were caught by surprise this year. And as a result, they really couldn't figure out how to trade. We were coming out of a really, really robust bull market. It was very easy to make money in the market. And so I think a lot of people, because they came into this time in which it was very easy to make money in the market, they started to have this perception that it was going to stay easy. And then once we started hitting some of these downturns, because most people don't know how to play the downside of the market, they really couldn't find trades. And because I got really good at finding the downside of the market, it was very easy for me to find trades in this market because the volatility didn't scare me and the downside didn't scare me. And what I'm going to show you probably this weekend was a Tesla trade I ran because I kind of understood that there was going to be a lot of downside to Tesla. Okay, and I think there's even more downside to Tesla before it kind of hits its price that most people are going to want to kind of trade it at. And a lot of people are caught by surprise. However, many people were just here because it was entertaining. Trading became like the hot thing to do right after the pandemic. Everybody was a market expert. Everybody had an opinion on it, for or against it. 99% of those people have never really done a real trade. They don't really understand the space. But what I'm going to do is kind of give you some insight on what I believe is the fastest way to six figures as a trader in 2023, based on what I've been consistently communicating to people and what has allowed me to have success. So when I get on these particular platforms and I start talking about trading, I'm not talking about things theoretically, right? I'm not talking about something that works based off of a template. I'm talking about something that works because I've applied it and I also know how to manage around it. So many people will give you a template and then they never talk to you again. So then therefore, if you have challenges or questions around it, you can never get back to that person. And what I'm trying to get people to understand is that when you're in the trading space, it's constantly changing. So you have to have the ability to adapt to the situation. You can't just be stuck on one thing. Doesn't mean you try to be an expert on everything, but many people will give you advice online about something. But the issue is that you don't know what you don't know until you don't know it, or until you do know that you don't know it. So then therefore, when you have new questions, you can never ask them, right? Because they're just giving you templated information. And I think that's why so many people struggle in 2023. So we want to ask, how come so many people were caught and surprised by this market downturn? How come so many people, after making so much money over the past 2 years, when the market turned on them, they couldn't figure out how to make any money? Their accounts started getting hammered. And they're always late to the party, right? It's easy to be on the bandwagon when everybody else is on the bandwagon, right? Because you are being affirmed by everybody else. However, where was their forecasting or their modeling of even the next 6 months to a year based on the market if they were so good at it? And that's one of the reasons why so many people got caught with their pants down in this market. Now, what was the real reason? Because we were in a quantitative easing or easy money era. And if you don't really understand this, then you don't understand the era that we were in allowed so many people to be successful. There's nothing wrong with that. But at the same time, if you're not being successful because you just really know what you're doing, but you're being successful because the environment is allowing you a large degree of success, you have to realize when that environment changes, you may not have that same degree of success. And many people get deceived into thinking they're better than what they really are because of the environment, not because of their own ability. And I think they make themselves believe I'm really good, but you're really not that good. It's the environment is allowing you to do what you're doing. And therefore, if the rules or the environment changes, you can no longer do that. Okay. And so as a result of this QE or easy money policy, the focus became on companies and CEOs instead of monetary policy. And what we saw pretty much over the past decade, but even a little longer, the focus became on companies. Everybody was company focused and CEO focused. Now, why does this happen? If you're running a financial platform, either on YouTube or even on mainstream television, most people are interested in companies. Why? Because it gives you something to talk about every day, right? You want something, you need content daily. CNBC needs daily content. Bloomberg needs daily content. Now, Bloomberg is more macro focused than micro, but even Bloomberg needs daily content. So what do we talk about? We talk about companies. We bring CEO in, yada, yada, yada. Why? Because we need to talk about these specific things to fill a content slate. If you're running a channel, you need content. So you got to fill your channel up with content. So the focus became on companies and CEOs, right? Everybody has a favorite CEO instead of monetary policy. But the question I want to ask you is that if you want to understand what's going on in the market, do you just focus on companies and CEOs, or do you focus on monetary policy? And I think that was a question a lot of people really couldn't answer, right? But if you believe that people are successful in the market because they're just smarter than everybody else, or they're running successful businesses because they're geniuses and everybody else is just not as genius as them, you don't understand that their business success is a function of monetary policy. Has very little to do with their genius, okay? So it's like you getting an allowance of $40K a month. So let's say every month I give you $40,000 for allowance. If you start to get into a repetition and that starts to become normalized to you, you start focusing on what you want to buy instead of the $40K. Why? Because you know what's coming every month. So if we're 3 years into me giving you $40K every month for an allowance, you now only focus on what you want to buy. Why? Because it's normal to me to get $40K every month. I don't want to know how I'm getting the $40K. I don't want to know what's creating the $40K. I just know over the past 3 years, $40K has come to me every month. Then therefore, all I think about is how to spend the $40K. I don't think about how the $40K is being created, where it's coming from, how long it's going to last, because it's normal for me to get $40K every month. So this is what happened to a lot of people in this market. When money was so easy for so long, all they thought about was, right, what else is there to do with the money instead of, well, what's creating this monetary policy? Because it became known, it had been going on for over a decade. Once monetary policy changed, it changed these things in the market, right? And let's get into it. So once monetary policy changed, it changed these things in the market. First thing, risk. We saw once monetary policy changed, people's understanding of the risk they were in was different. Now, why did that change? Because of the cost of capital. See, when we're in the easy monetary policy, I can invest in things that may not generate a return because I'm not tripping on them not generating a return because the cost of capital is so low. So if I can get capital at, 0.5% or 1%, and I can go invest it and get 8% back, or I can go invest it and get back 12%, but it's very risky. So it might not get 12% back. It might just go bust. But because the cost of capital is so low, my portfolio is constructed different. So when the cost of capital is really, really low, I can take on a lot more risk and can construct a different portfolio because of the cost of capital. Because if I do get a hit, I got a big hit with a low cost of capital. Next thing, valuation in regards to risk. How am I evaluating companies? So something I came in the gate telling people is we have a market full of companies that are driving revenue with very little earnings or negative earnings, negative profit margin, negative return on equity. But because of the cost of capital, nobody cared because the valuation was that eventually they'll start becoming positive in these areas. So with the cost of capital being so low, I don't mind taking on the risk around this particular valuation because we weren't tripping on in 6 years, they're finally going to be profitable because I can carry them for 6 years because of the cost of capital. Once that cost of capital goes up, then now what happens? The risk parameters change because it costs me more to invest in this. Why wouldn't I look for places where the rate of return is a little bit more secure and take less risk than put money into something very risky because I know the cost of capital is getting ready to go up or it has already gone up. Then earnings in regards to risk. We talked about before. Many companies are generating earnings. They're generating revenue with no earnings. Their earnings are going to be future dated, but we know because of the cost of capital, the value of those earnings are going to be less also in a high inflation environment. All of these things change based on monetary policy. But when we're almost at negative rates, we're at 1% rates, 0% rates. We can throw these out of the window. Why? Because cost of capital is so inexpensive. And I think that's what a lot of people don't understand because you don't have to understand it until you have to understand it in most people's minds. So as long as they believe that monetary policy is going to be a way in which they can take on this risk, in which they don't have to worry about valuation, in which they don't have to worry about earnings, but they just can look at revenue. But even though they're driving revenue, the return on equity, the margins of profit, the free cash flow is all negative, but it doesn't matter because the cost of capital is so low. I can just create a portfolio the way the things that do hit are going to cover for every miss. You got to understand, as the dollar becomes more valuable, it impacts the earnings of companies that do overseas, especially in tech. What we're seeing as the cost of capital goes up is going to impact the earnings of companies that do business overseas because the exchange rate is going to change. So as the dollar is weaker, it means that your business overseas is more valuable to you because of the exchange rate. As the value of that dollar goes up, you don't get that same rate of exchange. It starts to skew what your actual earnings are. So as we know that the cost of capital goes up, as the Fed's funds rate starts to rise and they start to take liquidity out of the market, the dollar becomes more valuable. It starts to impact tech, but especially tech that does business overseas. So end of the day, right? The financial system is based on macroeconomics. And that's why when everybody would ask me, what do you need to read? Right? Like, what books do I need to read? Everybody thinks there's a magic book. I told people, you want to read The Crowd and just go get you a microeconomics book on a college level from Amazon. You can get them used. Right? You may even be able to get it from like a college bookstore used. Because I understood that this particular system is based on monetary policy. It's not based on CEOs being geniuses, right? It's not based on this company being so much better. Do you got some really top-notch companies in the market? Yes. But what we are dealing with and what we dealt with for so long was quantitative easing and easy money policy. And I don't create like an anti-Fed channel. I don't create a channel where, we're going to give you the secrets of the Federal Reserve. I understood the monetary policy as a function to make money. Outside of that, it doesn't matter to me because I'm not going to be able to get rid of the Federal Reserve. So I don't market to a crowd of people that don't like the Federal Reserve just because they don't like the Federal Reserve, but they're never going to do anything. The goal of understanding this is understanding what type of environment that I'm in. And based on that environment, how can I get more successful in the financial markets? Because I understand once they change the monetary policy, which are the rules of the game, is going to change the actual construction of the market profile. So really quickly, what we're going to do is get into some really quick videos on what is macroeconomics, what is monetary policy, and what is the federal funds rate. Because just by understanding these basic concepts is how you start becoming a little bit more successful in the market. And I think one of the reasons why so many people struggle is they're caught into the minutia before they understand the big picture, right? And they don't understand how to apply the big picture to what they're trying to do. So let's get into these real quick.
Macroeconomics, if you sort of think about the words individually, would mean large economics. And it's the study of whole economies and the sort of big sectors and how they interact in economies. And a macroeconomist would study such questions as what makes the business cycle, what makes economic growth go up and down, how are prices determined, and what is the rate of inflation and what determines it. What's productivity growth and what are the determinants of productivity? And also, importantly, what role does government have in determining the pace of growth, the long run rate of potential output in an economy, and the inflation rate? So, all of these issues a macroeconomist would study. The Fed cares about macroeconomics because its goals are defined in macroeconomic concepts, having stable inflation or stable prices and having maximum employment are things you measure and achieve on a sort of economy-wide level, not at an individual level. And because those are the Fed's goals, it often thinks in terms of macroeconomics.
Economies don't always perform the way we like. Getting them back into winning form takes careful strategy. That's why we need a monetary policy. Our nation's monetary policy is an economic strategy that influences interest rates and the supply of money and credit. So, why does this matter to you? A good monetary policy promotes price stability and high employment. That means people can find jobs and make better informed choices about what to spend, and businesses can make better informed decisions too. That helps keep the economy moving in the right direction. It's the Fed's job to come up with that monetary policy. In 1913, Congress created the Federal Reserve to provide a more stable and secure monetary and financial system. The Fed's role in the economy has evolved over time. Sometimes what has ailed the economy is a sudden need for liquidity. During a financial panic, the public's demand for cash can catch banks by surprise. And since most of the money that banks hold is tied up in loans, they may find getting their hands on cash difficult. Acting as the lender of last resort, the Federal Reserve can lend money against a bank's good assets and prevent the financial panic from disrupting the economy. This tool is called the discount window. In 1977, Congress amended the Federal Reserve Act, stating the Fed's monetary policy objectives were to maximize employment and maintain price stability. That's what is now called the dual mandate. For more than 100 years, the Fed has used its policies to help our economy run smoothly. To create a monetary policy that will work best for the entire nation, the Fed needs a lot of grassroots information. Where does it come from? From farmers and real estate agents and car dealers and factory owners. All over America, different kinds of Main Street people share what's going on in their own businesses with their region's Federal Reserve Bank. The reserve banks gather this information and combine it with economic statistics like inflation measures and employment data. Then, from all over the country, that information heads to Washington, D.C. 8 times a year, the 12 Reserve Bank presidents, along with the Fed's Board of Governors, meet in Washington and report on their regional economies and present their economic projections. The Federal Open Market Committee, or FOMC, combines all these detailed views of what's going on nationwide and studies the whole picture. At the end of each FOMC meeting, the voting members, 5 of 12 Reserve Bank presidents, and the 7 Fed governors, cast a vote on setting monetary policy. Decisions on monetary policy are immediately communicated to the public. To build a healthy economy, the FOMC needs good tools. If the Fed needs to adjust interest rates and affect inflation, it uses open market operations, which is the buying or selling of government securities. Buying or selling these securities expands or contracts the supply of money in the banking system. Raising or lowering the federal funds rate, which is the interest rate banks pay each other for borrowing money that is maintained at a reserve bank, also helps affect the inflation rate. And finally, all banks are required to have reserve requirements, nest eggs set aside and kept at the ready so the economy stays fluid. To meet the challenges posed by our last recession, the Federal Reserve developed new tools and communications for the extraordinary circumstances following the financial crisis. One of these is forward guidance, which is the Fed's description of its likely future policymaking. This helps shape the market's expectations of interest rates. Another tool is quantitative easing, which is a way to inject liquidity into the economy and help keep long-term interest rates low. No matter what tools or policies the Fed is using, we'll always let you know what's going on. That's why the Fed chair holds press conferences after FOMC meetings once each quarter. Also, other Fed officials deliver public speeches and testify before Congress about the Fed's actions. Why is all this important? Ultimately, all these factors work together to create an economic strategy that works for each region, making our national economy run smoothly across the board. To find out more about this and other topics, visit us at frbatlanta.org.
The Federal Open Market Committee, or FOMC, meets and sets a so-called federal funds rate, or Fed funds rate. To understand how it works, please note that 1. Commercial banks are required to keep a certain percentage of their deposits as reserves at the Central Bank of the US, the Federal Reserve. 2. Anything which exceeds that minimum can be lent to banks which need additional funding, and the federal funds rate is the interest rate at which the Federal Reserve thinks this should be done. 3. While the Federal Reserve cannot force commercial banks to lend to each other at the federal funds rate, and the actual rate ends up being negotiated between the banks themselves, let's just say it sets a target and has various tools at its disposal to make interest rates move toward the target in question. 4. The weighted average calculated across all such bank-to-bank transactions is called the effective federal funds rate. 5. If, for example, they cannot borrow from one another for various reasons, banks can borrow directly from the Federal Reserve on a very short-term basis at the so-called discount rate it sets, but more on that in another video.
Okay, so what is the benefit of understanding macro micro? Because the average person is going to look at this and say, well, why do I need to learn this? I didn't really learn it in school. Why do I need to benefit this? Like, what is it going to do for me? How is it going to help me solve the problems I have in my life? And that's a legitimate question. You can understand why things are happening in the world and how you can capitalize on them. So as a trader, you need to understand, why do you believe things are happening in the world and how I can capitalize on them, right? You have to have some kind of idea inside your head. That's where the trade is at. The same way if you were to go into the real estate market, the same way if you were to go into the bond market, the same way if you were to go into the forex market. You need to have an understanding of why things are happening in the world and how you can capitalize on it. That's why I used to always ask people, how do we make money off of it? And we start changing the narrative around, because everybody else is thinking that, right? So I do this inflammatory promotion to get attention to me because I got a documentary coming out in the next 2 weeks. That's how I make money from it. I do an inflammatory promotion to get attention to me because I have a fashion line I'm getting ready to drop. That's how I make money from it. The average consumer never asks themselves, based on what's going on in the world, how do I make money from it? Because they're just supposed to sit back and be reacting to everything, as opposed to sitting in their groups and say, okay, this is going to happen in the world. How do we make money from it? It's like back in the day, I used to live by a stadium. If you know they bring your games into the stadium and you got a yard big enough, you can park cars. That's how you make money from the games. We're not taught necessarily how to capitalize on situations. We're just taught to react to everything, and then everybody capitalizes on our reaction. Second thing, people can't lie to you around the cause of what's going on. You can't tell me that this is Joe Biden's economy. It's not Joe Biden's economy. It's the central bank's economy, right? It's the investment banker's economy. The president doesn't determine the economy. It doesn't work that way, right? Therefore, you can't tell me that this is Joe Biden's economy, right? You didn't make money because somebody was president unless they created a program, but the president doesn't oversee the economy because the president doesn't determine money printing. And then once you really start to understand how the economy is actually constructed, then you know what the actual leverage is in the economy that's going to put you and your group in position to be successful. And you don't argue with people because the majority of people don't know it. The gas price is not high because Joe Biden will or will not do something. That's not how this works, right? It doesn't work that way. And so that's what I want people to understand, is that this is why this is important. And this is what allowed me to have so much success. I keep studying. I read The Economist probably every other day. I read Financial Times pretty much every other day. Those are the two main publications I read because they give me a lot of macro information. And then I use that macro information to make micro decisions. Same thing in the VIP. I taught people how to break down their market analysis from a top level view all the way down to a bottom level view. And I just do that over and over and over and over again. Are we going to go back into a quantitative easing environment? Most likely we will. But that still doesn't change why things are happening the way they're happening. It's just going to make it easier for a lot of people, but it also should make it easier for you. And this is, in my opinion, what separates people from the pack. This video won't trend like the Candace Owens, Kanye West video, but it's also the reason why the average American will not make over $50,000 this year, because they have not made this type of stuff important. Therefore, if it's not important to you, I would encourage you in your group, be able to develop somebody that understands these topics, because this information and this topic is one of the reasons why when you go to the grocery store, your bill is higher, right, than it was 6 months or a year ago. It's because of these topics. And then you start to realize, well, what do I need to do to try to offset this? Because I know it can get even worse before it gets better. But this is the reason why, right, the average American, white, black, green, or purple, won't make over 50 grand this year, because they have not made these things important. And once you start to make these things important, you start to really realize some of the discrepancies in the system, some of the inefficiencies in the system, and a lot of the lies that they've told you about how the system actually is constructed, that you're still going to have to deal with, but you're not on a false pretense about how the system actually works. And if it's not important to you, I would encourage you to make it important to a member of your group and make it your specialty, or you're going to just have to deal with whatever happens. And that's the situation that most Americans are in. So we're going to go ahead and read the questions. If you got any questions, hit me up. In fact, if you want to come on the live stream and you want to talk about how to get to 6 figures as a trader, information about what I talked about, that's the StreamYard link. You don't have to show your face, and just treat it like it's a gender war, what you would call it, live stream, where you got 30 people on. I saw one people talking about that Candace Owens, Kanye West. I went to bed and they was talking about it, and I woke up in the morning, they were still talking about it. I don't know how people got that much free time, man. But big up to the platformer, because you're making your platform very valid by keeping it going that long. But I don't know how people, I wake up early, they beat me up. They talk about Candace Owens and Kanye West, and they was talking about it when I went to bed last night. So really quickly, the sponsor of the show, right? Let's talk about the sponsor of our show. That is a big sponsor of what we're doing and what we're trying to get out. It's Know Better, Do Better Consulting. So the question is, are you interested in learning how to trade options in a one-on-one format, right? So which one person teaches you. Reach out to Dr. Chassie at Know Better, Do Better Consulting. You will learn step-by-step what platform to trade on, how to trade, and most importantly, how to consistently pull money out of the markets. Book a free consultation at the link provided. That's going to also be pinned in the chat. Receive 20% off, and your session is going to only be $60 an hour instead of $75 an hour. And mention this particular channel when booking, and you go to redeem this particular offer so we can know where it came from, right? So that's the sponsor of the show. We're going to read the comments and we're going to get up on out of here. So King Moo, what's going on? What's going on, Miss Lady L? Where am I from? I'm a Florida native. Terrence J, what's going on from New Jersey? Julian, what's going on? I think he's from Jersey too. GC, what's going on, man? Elliot, I appreciate it. No problem. Definitely. Julian Brown, how can we make money from it? GC says Joe Biden doesn't control monetary policy. Definitely. No president controls monetary policy. And it never let. And in a way, it could be a good thing. Because do we want a political party to have control of our monetary policy? Because what can they do? They can print a whole lot of money and give it to their constituents. We see this happening in places like Central America and Africa. So if one political party controls monetary policy, what would stop them from printing a lot of money and giving it to their constituencies, or telling people we'll trade money for votes? Now, you can do that with programs, but they can directly do it with monetary policy, right? So this is what people, and this is why I can't have a really in-depth discussion about monetary policy, because most people don't understand enough. But what they do is they take people's frustration about their economic situation and they point it at the Fed. But most people don't really understand it to understand, well, what would be the alternatives? You know, people say, well, we need to go back to the gold standard. Well, do you have an understanding of what the economy will look if we hinged every dollar to gold? We would get a contraction in the economy. Most people's lifestyle is a result of expansion, not contraction. So that's the issue. But we don't, in the school system where I'm from, K through 12, you get 1 semester of economics in 12 years of education. So the average person graduating from high school don't even know. You also get 1 semester of civics. So we produce a person that, even though they can be valedictorian of a high school, we've given them 1 semester of civics, so they know nothing about how the government works. And we gave them 1 semester of economics, so they don't really understand the economic system that they live in. And they could be valedictorian of a high school, have AP classes, the whole 9 yards. It don't matter. That's all they're going to get. So anything after that has to come from their parents or own personal education. So we got Mr. James here. What's going on?
How you doing today? Can you hear me?
Yeah, I can hear you. What's going on?
I'm good. How you doing today?
Doing good.
Yeah, I just tuned in. You talking about trading? Me myself, I trade futures. I know
Okay,
you trade
so
options.
Yeah, so I want to ask you, do you have any questions about what we talked about in the video?
You mentioned if someone was to come on and help give pointers on how to trade to 6 figures.
No, sir, that's not what I asked. So I said, if you have any
my
questions about it,
apologies.
no problem. If you got any questions about what we talked about in the particular video, about how understanding microeconomic policy can allow you to be a much more successful trader, and you had any questions or comments around that, that's what I was asking people to come on for.
Oh no, I apologize. I misheard you. My apologies.
No problem, man. Be easy.
You too.
All right. So that's what I want people to really understand, is that when you really start to kind of understand this from a microeconomic standpoint, it can allow you to understand the environment that you're operating in, and it can put you in a better position to be successful. Most people, this is not interesting to them, but this is what allowed me to have a lot of success. And just going through the same process over and over and over again and really trying to understand this. And that's why I tell people, you want 3 books, Read the Crowd, which you can get off Amazon for like less than $30. And then just go get a used college book on microeconomics. And you'll have a better understanding of how the markets actually function than the average person that's watching CNBC every day, and they're jumping on Twitter and they're trying to find a hot ticker, yada, yada, yada. So we don't have any questions, man. We're going to get up on out of here. I appreciate everybody for coming through. This is David W. Williams, also known as Diamond Dave. I'll talk to you later.